Welcome back to DeFi. Um, I don't know. It's kind of weird starting these things, man. Did y'all hear any crazy knocks? Blame my insane washing machine. It's Saturday, so we got to get the clothes clean. With that being said, though, the market is in shambles. That's how I like it. That's the most interesting. You see it. I love to see the stock markets. Crypto, everything. Not only is it a good time for me to accumulate more assets, it's also a good time to sit back and reflect on money. But the real reason why markets have tanked this week is quite simple. It's going to boil down to one thing and one thing only. The United States raised interest rates. A lot of people hear the Fed raises interest rates. What does that mean? I'm glad you asked. A lot of people don't understand the concept of the price of money. And I need my glasses now. I'm just about to deal with this glare. The price of money. So the price of money is interesting. Well, let me say it like this. Let's say you drive down the street, right? Gas tank on E. You got to slide out for the night, right? You're going out to the club, whatever, you're going what you're going. And you see two gas stations. And we know Exxon be high on average. So I'm going to blame Exxon. Let's say Exxon gas, $4, right? Across the street, Kroger gas, they always messing with us. Kroger gas is a simple $2. Where you gonna get gas? The same response is Kroger, right? The price of gas determines where you get gas, right? So now we come back to the price of money. The price of money is often reflected in interest rates, and it determines whether or not where people put their money. Where does money go? If money goes to the place where the price is highest, which is completely opposite to humans. When we go to spend our money, we go to the place where the price is cheapest. Interest rates follow. If you saw a bank account and one was offering you 0.01% interest and the other offered you 1% interest, you're gonna go to the 0.1% interest, right? So the interest, like you looking for the higher the rate of interest, that's where you're going every single time. So at least is where you should go. We do recognize anomalies. Sometimes people might just like holding down Exxons. I really don't know how Exxon they overcharge everywhere. But you just might like going to Exxon, or you got people that just got loyalty to that degree. And if that's you, by all means. But for me, I'm gonna go every single time. I'm going to the lowest prices when it comes to spending money. When it comes to saving money, I'm going to the highest interest rates. Now we get to saving money. The government's like, hey, people are spending too much money. We have to raise interest rates to stop people from spending money and to encourage saving. But modern economies are built on hyper consumerism, right? Like I need people to consume a ton of stuff to have a successful economy. Like that's what it is, right? John Maynard Keynes, he made that like the prime thing. It's called aggregate spending, aggregate demand. Get aggregate spending up. Doesn't matter how you spend money, but money needs to be spent. What that being said, governments, that's why they print so much money when money's not being spent. They just like, all right, we're gonna spend the money since they're not gonna spend it. We're gonna spend the money in hopes to encourage them to spend money. So I mean, I think that's like the biggest thing, and I hope people like really understand the concept of the price of money. Um, it's important. So when you're talking about billions and billions of dollars, or euros or yen or whatever, people are more happy in times like this to have their money in what they call a hard asset. Now I know me and David have talked about hard assets before, but a hard asset is something that is less likely to lose value over time. That's where they're going. Where is my value going to be maintained over time? Over time, people are willing to bet on, you know, US dollar. And there's good reasons for that, right? Like, we've seen the Russian ruble rise in the past months. Well, Russia is still one of the largest oil producers in the world. So like they have like hard assets behind their currency, right? The United States, it has hard assets behind its currency, plus a military that goes against whatever it wants. And I mean, I do think the military has been a boon to the United States dollar over the course of the last at least 100 years. What else? That's why Britain and Europe are suffering right now. Euro is, I mean, I remember when Euro was almost $1.50, maybe $1.40, $1.30 probably. Like back like maybe 2016, I remember like looking at Euro, like, why is Euro worth more than a dollar? But like they have to their economy, but they're a producer economy, right? So when you produce stuff heavily, your currency is worth more, right? I It's just how it works. I could explain it to you, but I really hadn't like looked into it. I can just tell you these are facts. When a country is a major producer of something, their currency is worth more. Whereas when your country is heavy on imports, your currency is worth less, right? A lot of countries, like the Turkish lira, he's deliberately devaluing the Turkish lira. What's his name? I I think his last name is Erdogan. Yeah, I know his last name is Erdogan. He's the like prime minister of Turkey. He's deliberately devaluing the Turkish lira, but like as a result, they've been exporting stuff like crazy. And the reason why is because it's cheaper. The currency is so much cheaper, right? So as your currency gets devalued, people are more likely to buy your goods. So like Europe being a producer nation, it's like importing super far more than it's used to, and its ability to produce isn't it's not producing as much as it used to. So the currency has to fall to a place where people are more keen to purchase European goods, right? Once again, price of money. So people, the price looks good. So like American producers who buy European goods are now like, oh, okay, a couple months ago they may have spent $1.20, on a euro, but now they're spending at parity. They're more likely to buy, well, at parity means, equal value. So they're more likely to buy a European good. Now, same with, I think the British pound is going down. I mean, a lot of currencies are just dang, except for the dollar. The dollar's going up. Why? Because people are selling euros, they're selling yen, they're selling everything to buy US dollars. And here, you got the Federal Reserve meeting minutes. I don't expect any of y'all to read this. This is something I read. But if you do want to get like, an expert opinion or see exactly what they're saying, this is the best place to go. It's going to tell you exactly what they're saying. It's like, you look, I'll highlight a couple of things: higher food prices, energy prices, and broader price pressures abroad. Russia's war with Ukraine. I was going to pull up Ukraine's easy target. I think it's more easy to blame this on like generally printing, I don't know, $6 trillion in the last 2 years, 3 years. So, I mean, that's just me. I don't know. The committee seeks to have maximum employment and, lower inflation, right? That's their goal. Congress gave them that target. That's their job to control money to give that. But a lot of people also don't know the Federal Reserve's job is to make sure that Congress can always afford to finance something. I think like I don't think that's their official mandate anymore, but I'm pretty sure back in the 40s, post World War II, that was in their mandate through the U.S. Treasury Secretary. I think they decoupled from the U.S. Treasury Secretary in the 40s, and U.S. Treasury branch and made their own like little situation. And this is what happened. It's a good thing. The price of money needs to be separate from government, even though it's still a government agency, and they still mess everything up because their job is to make sure Congress can finance everything. So when Congress doesn't have money, these guys print it up, they set it up, they do whatever they gotta do. But yeah, you can read this. Once again, you don't really have to read it. It's not that important for you unless like you really want to get into understanding, Fed rates and stuff like that. But this, it tells you that they voted unanimously to raise rates to 3.15. So rates are really somewhere between 3% and 3.25. They vary. They give them a little of variance. And so Fed funds rate is like if a bank needs to get a loan from the Federal Reserve overnight, or over the course of a week or a month, to handle this business. They can get that money from the Federal Reserve, and this is the rate that they charge banks to do this. And so when this happens, you see bond rates, bond yields, they start, getting a little bit higher. So you look at the 1-year bond, it's over 4%. The 2-year bond is over 4%. The 10-year bond is at 3.6%. The 10-year and the 2-year should not be over the 10-year. I'll repeat that again. The 2-year bond should not exceed the value of the 10-year, but as you see, it is about 5 points over, which is 500 points over. So that's ridiculous. Similarly, the 1-year is eclipsing the 1 and 6 month are eclipsing the 30-year, which is amazing. Once again, I've never seen this. I genuinely think we're in a period right now where everything we're looking at we have never seen before. That's important. But you might ask, how did it happen? So come Tuesday, nope. See, they trying to get my money. But come Tuesday, major banks raise forecast for the Fed's hike rates. And I think what happened with the hike rates for me was Jerome Powell said one thing that blew my mind. He said that they were going to achieve 4.5% interest rates by the end of the year. 4.5% means that interest rates they'll probably raise interest rates by 75 and 50 in the upcoming meetings, which will be like the first week of November and like sometime in December. They'll raise 75 and 50. And then or it could be like 50 and 75, or it could be 125. It doesn't matter how he does it. But the Fed's attitude on inflation has really turned, and what's really signified is it was like, when asked the question what rates will be at the end of next year, Jerome Powell was like 4.6%, which means they're not cutting rates anytime in 2023. And without cutting rates in 2023, all rates are going to just be high everywhere. And you're like, once again, how does this affect me? Well, the combination of the Federal Reserve raising rates and these high bond yields give you this. All right. So we're just going to take it. The average price of a house right now is not $300,000. So we're going to go with 400 because that's a little bit closer to the average. All right. We're going to assume that you have 20% to get put down, which means 20% of 400K is like, I'm pretty sure it's $80,000. I ain't got 80 bands. I'm pretty sure most of you don't either. So you run it, and this is how it would go. And you would have a 7%. You have a 7% APY. And if you just look at it, if you calculate your mortgage at 7%, let's give it a shot. Calculate mortgage. Yeah, calculate mortgage payment. Let's see. Come on, Google. I know you got. There you go. So if you got $400,000, right? $400,000, and you had $80,000 put down, it means your loan value is $320,000. Right? So your monthly payment is $2,220. All right. Now, let's say you had a $450,000 house, you put down 90 grand, that will put you at 340, right? That was pretty much the same. 2,300. Mortgage payments, because of the average price of houses and high interest rates, are literally outrageous right now. This is higher than my rent, and rent is ridiculous, significantly higher than my rent. So I want y'all to know, like, when this guy right here says the price of money goes up, and these things right here react to that, the thing that you see is that you can't afford a house, or you might not be able to, or affording a house, you won't be able to afford a house that your parents got, right? Because, if I were to play with this interest rate and do 2.7, 2.8, okay. If I play with this interest rate, just do 2.8, you're talking about $1,300 monthly payment. 2.8. Like most of our parents had 2.8, percent interest, and I mean, it's ridiculous. I mean, we can look at the history, as like I said, you see rates just climbing up steadily. So as he continues to, do what he's doing, we're going to see rates go up. It's just in the bottom line. The markets reacted pretty horribly to this. Um, I'm just going to go over U.S. markets. I know we live in a global world, but U.S. markets is where I'm going to go. And if you just look at the Dow Jones this week, it was just Friday. It was down 500 points, 52-week low. I didn't even know that was what we're doing. Yeah, this is how we slide today. We're gonna go year to date. If you go year to date, like the thing's down stupid year to date. I mean, we're talking about it started at 36,000, it's now 29, and it's probably gonna go lower. I have a bottom of like 27,000 points for the Dow. My personal, thought. I don't think the Dow is gonna go too much further beyond 27,000 points. It's just because there's so many more investors now. Like we have Robinhood people, all those tiny apps you can buy stock on Cash App. The market caps these things have exploded because you're giving money to just regular people like me and you, and then like they go ahead and like just give us all the money. We got extra money. People want to invest. We never had a chance to invest, and boom, this happens. Yeah, but I'm really crypto guy. So we're gonna go to CoinMarketCap real quick, and I will show you guys similar to Bitcoin and Ethereum, right? So Bitcoin's down like 3.6% this week. Not bad, Bitcoin. Bitcoin's been holding it down for the team, but Ethereum, on the other hand, 6.12. It's pretty horrible. It's cool though. Ethereum's not going through it like that. What's mad? It's probably gonna. Oh yeah, probably gonna. Yeah, CoinMarketCap don't like to load for me. But still, the markets are just in turmoil. Crypto markets are down, and I don't think Ethereum was down because of this, but I'm going to cover it anyway. Earlier this year, we had this guy come on the scene. His name was Do Kwon. He was like the guy who was in front of Terra, which was a blockchain, and they had this UST stablecoin, and it blew up. And when the UST stablecoin exploded, this guy was, it seemed to be at fault for it. All right. So, like, the United States is like, all right, so we need to regulate cryptocurrencies. Too much money is out of the market. They need to regulate for their betterment, right? They need to improve regulations. And I personally think that stablecoin regulation needs to come first. Like, that's what we need. We need Ethereum and Bitcoin to be listed as, commodities, and the other ones probably as securities. But they can't really be securities because there's no like centralized head, right? So like they'll have to be a special type of security, but that's a whole nother conversation. Endpoint, this little guy, they gotta have a picture of the guy. Where is Gary Gensler? Okay, he looks like a loser. I'm not even gonna show you a picture. Don't even look at the picture of Gary Gensler. Gary Gensler a weirdo to me. I don't know why you would be opposed to cryptocurrency being labeled as a commodity, but he's the chairman of the Securities Exchange Commission, so he would like it to be a security, so it's under him. But I think some crypto is commodity, some crypto is definitely can't call them, I can't get my words together. Some crypto is definitely we're gonna put a blooper on this part. Some crypto is definitely a security, some is definitely a commodity. Nonetheless, he made a claim. Like, what was his claim? Well, here's his claim right now, right? 36% of the nodes on the Ethereum blockchain are in the United States. 36.92, 37. So we'll say 37. So that means every transaction that happens on the Ethereum blockchain, 36% of those transactions are going to come to the United States every single time. Like, that's just how it's going to roll. And I don't know how the node infrastructure works, but like if it's up to me, like every node is up to date, but like your nodes carry transactions to the validators, I think, or they make everything equally available. They all work together. I'm not sure how it works. Maybe we can do an episode on that. Yeah, that sounds good. Regardless, the nodes are responsible for all the transactions, and so they're a part of transactions, and yeah, it's important for you to recognize that When you look at it, the United States and Germany control 58.8%, almost 60% of the node market right now. So it's important for us to like take a look at it. He was like, well, hey, a lot of these nodes are in, over a third of the nodes are in the United States. So, the United States controls Ethereum, which means every single transaction on Ethereum blockchain is uh, subject to the SEC, which is cool, right? I mean, if that's what he wants to believe in his chest and his heart, by all means. And so like they're accusing like Ethereum's, price drawback to be as a result of that. And I don't think that's the case, but it is what it is. Um, yeah, I mean, it is what it is. I don't really think that's what really causes something like that to happen. I think it's more or less like it's a power play, man. I mean, it's a threat. It's a new financial system, and the reality of it is, there's $1 trillion in crypto. And if I were to go with stablecoin regulation, I'd just be like, hey, every stablecoin that's validated and used in the United States needs to be backed 100% by United States bonds. If you are a United States dollar stablecoin, you're going to be backed 100% by U.S. bonds. That gives bonds a new buyer. They'll have a new buyer. So if you want to mint new stablecoins, hey, you got to have that. And I have a quarterly report, public quarterly report, and they'll call it a day. So the United States gets to have someone who's infinitely buying U.S. bonds, and then crypto gets to have the stablecoins. I'm also a fan of like decentralized stablecoins backed by decentralized currencies, having a floating value, just like every other currency does, right? I mean, like it might not be worth $1 flat every day. It could be worth 90 some cents. It could be worth 96 cents. But we need a floating currency, for crypto markets to really take hold. We need to stop like living through what do I want to call it? No, US dollars. It shouldn't be like that. But I mean, it's cool. I mean, I feel like crypto market is just growing up, and we're in a very interesting time. I've always said, well, I felt for a long time that what we're going through is going to be a decade long event. So at the end of this episode, like always, I'm gonna make sure you guys know, that, hey, this is not financial advice, but if you do want to invest, you take time to invest in anything, whether it be cryptos, whether it be stocks, whatever. If you take time to invest, now is a time. But I do want you to have it in your head and in your heart that you won't see the fruits of any of your investments until 2030. That's it. 2030. If you can invest, $25 every time you get paid, 10, 15, Cash App exists every single time you get paid. Hey, if you're just gonna buy $10 worth of Apple stocks every time you get paid, that's your game. I respect it. It's not a bad idea, and I would advise you to do it. I think it's a smart move. If you want to buy $10 worth of Bitcoin, that's on you. It's however you want to do it. I just don't think it's responsible right now to be living in this world not investing. You need to put your money somewhere. Because you just won't get the returns that you need to afford a house when mortgage rates are 7%. And I'm going to tell you, they're going to get higher. I can see mortgage rates easily being 10%, double-digit numbers sometime next year. Bond prices could probably, we could see a 5% yield on maybe the 1 and 2 year by January. It's possible. I mean, the oil markets could still collapse. We don't know. I mean, the price of oil has fallen tremendously. We've not necessarily seen it at the pump, but it has fallen tremendously. And it's possible that it could continue falling and, then suddenly take an insane rise going into the wintertime. We don't know. I mean, I got to do an episode on that. It's called Radical Uncertainty. And I want everyone to understand the idea of how you cope with radical uncertainty by understanding the risk, familiarize yourself with every risk humanly possible with every investment that you make. Whether you're saving your money for the future, you realize that hey, my bank account is giving me 0.06% interest, and the risk of that is that inflation could go well beyond 2%. In this case, inflation is already 8.3%. So if you have $10,000 in a bank account and you only get 0.06% interest, you're losing 8.3%. So it's like 7.7% negative yield. negative. Yeah, that's your real yield is negative 7.7%. And if inflation continues to rise, and you see the price of houses are going crazy, and stuff like that, you're losing money. It's important to have money to hold it, to do what you can. I mean, make your money work for you. That's the goal. But once again, it's not financial advice. Um, we got a heck of a time ahead of us. The Federal Reserve they're playing a game right now, and I can't do anything but watch them. So, uh, you know, I wish it was a more happier episode, but I don't know how to put it in any other way except for you know invest, save with full understanding of the risk of investing and saving. That's all I can say. What else? Yeah, I think that's all, man. Federal Reserve is coming to bite us in the butt. We got to keep it pushing and save, invest, make your way. That's all I can say. You guys have a good time. Enjoy yourselves. Like, save, subscribe, all that. Yeah, for sure.